Hello everyone and welcome back to my channel. In today's video, we'll be discussing stocks. Whether you're new to this channel or a long-time subscriber, I'm excited to share my knowledge and insights with you. So, grab a cup of coffee, sit back, and let's get started. Introduction to the basics of stock investing. The basics of stock investing is a fundamental concept for anyone who wants to invest their money into stocks. Investing in stocks can be a great way to grow your wealth, but it can also be risky if you don't know what you're doing. Here are some of the basics of stock investing that you need to understand before investing your money. What is a stock? A stock represents a share in the ownership of a company. When you buy a stock, you become a part owner of that company. Why do companies issue stocks? Companies issue stocks to raise money to fund their operations and growth. By selling stocks, companies can raise capital without taking on debt. What are the risks of investing in stocks? Investing in stocks comes with risks, including the possibility of losing money if the company's stock price drops. It's important to do your research and diversify your investments to minimize risk. Risks involved in stock investing and how to minimize them. Investing in stocks can be a great way to grow your wealth over time, but it also comes with risks. Here are some of the risks involved in stock investing and ways to minimize them. Market risk. This is the risk that the overall stock market will decline, which can cause your portfolio to lose value. To minimize this risk, you can diversify your portfolio across different industries and asset classes. This will help spread your risk and reduce the impact of any one stock or sector. Company risk. This is the risk that a specific company will underperform or go bankrupt, causing you to lose your investment. To minimize this risk, you can research the companies you are investing in and look for those with strong financials, a solid track record, and a competitive advantage. Interest rate risk. This is the risk that rising interest rates will cause bond yields to increase, making stocks less attractive to investors. To minimize this risk, you can invest in stocks that are less sensitive to interest rate changes or look for companies with strong financials that can weather any interest rate changes. Inflation risk. This is the risk that inflation will erode the value of your investments over time. To minimize this risk, you can invest in companies that have pricing power and can raise prices to keep up with inflation. Liquidity risk. This is the risk that you won't be able to sell your investments when you need to. To minimize this risk, you can invest in stocks that are highly liquid and have a large number of buyers and sellers. In addition to minimizing these risks, you can also manage your risk by setting investment goals, diversifying your portfolio, and staying disciplined in your investment strategy. By taking these steps, you can invest in stocks with confidence and minimize your risk over time. Advantages of investing in stocks. Investing in stocks has several advantages that have made it a popular choice for many investors. Here are some of the advantages of investing in stocks. Potential for long-term growth. One of the biggest advantages of investing in stocks is the potential for long-term growth. Historically, stocks have provided higher returns than other asset classes, such as bonds or cash. While there is always some volatility in the stock market, over the long term, stocks have a track record of providing strong returns. Diversification. Investing in stocks can provide diversification benefits. When you invest in stocks, you can choose to invest in companies from different sectors, industries, and geographies. This diversification can help spread your risk and reduce the impact of any one stock or sector. Dividend income. Many stocks pay dividends, which can provide investors with a steady stream of income. Dividends are typically paid out quarterly or annually and can be reinvested to buy more shares, which can lead to compounding returns over time. Liquidity. Stocks are highly liquid, which means that they can be easily bought and sold on the stock market. This makes it easy for investors to enter and exit the market quickly and efficiently. Ownership. When you invest in stocks, you become a partial owner of the company. This can be empowering for investors who feel like they are contributing to the success of a business they believe in. Access to professional management. If you're not comfortable picking individual stocks, you can invest in mutual funds or exchange-traded funds, ETFs, that provide access to professional management. These funds are managed by professional fund managers who make investment decisions on behalf of investors. Overall, investing in stocks can be a great way to grow your wealth over time. While there are risks involved, the potential for long-term growth, diversification benefits, dividend income, liquidity, ownership, and access to professional management make it a popular choice for many investors. How to research and evaluate stocks before investing. Investing in stocks requires careful research and evaluation to make informed decisions. Here are some steps to help you research and evaluate stocks before investing. Define your investment goals. Before investing in stocks, you should define your investment goals. Are you investing for short-term gains or long-term growth? Are you looking for dividend income or capital appreciation? Defining your goals will help you choose the right stocks to invest in. Analyze company financials. One of the most important steps in researching stocks is to analyze the company financials. This includes analyzing the company's revenue, earnings, cash flow, debt, and other financial metrics. You can find this information in the company's financial statements, which are available on the company's website or through financial news websites. Understand industry trends. It's important to understand the industry trends that affect the company you're considering investing in. You should research the industry's growth prospects, competition, regulatory environment, and other factors that can impact the company's performance. Read analyst reports. Analyst reports can provide valuable insights into a company's performance and prospects. You can find analyst reports on financial news websites or through your brokerage account. Check the valuation. You should also check the valuation of the company you're considering investing in. This includes analyzing the company's price-to-earnings ratio, price-to-book ratio, and other valuation metrics. This will help you determine whether the company is overvalued or undervalued. Look for catalysts. Finally, you should look for catalysts that can drive the company's stock price higher. This can include new product launches, strategic partnerships, or other positive developments that can boost the company's growth prospects. By following these steps, you can research and evaluate stocks before investing to make informed investment decisions. Remember to always do your due diligence and consult with a financial advisor before making any investment decisions. Different investment strategies for stocks: value investing, growth investing, dividend investing. There are various investment strategies for stocks, and the three most popular ones are value investing, growth investing, and dividend investing. Here's more about each strategy. Value investing. Value investing is a strategy where investors look for stocks that are undervalued by the market. In other words, they look for stocks that are trading at a discount to their intrinsic value. To identify these stocks, investors analyze financial statements, ratios, and other metrics. They look for companies with strong fundamentals, such as low debt, high cash flow, and a history of stable earnings. Value investors believe that the market will eventually recognize the true value of these companies, and the stock price will rise accordingly. Growth investing. Growth investing is a strategy where investors look for companies that are expected to grow at a faster rate than the overall market. In other words, they look for companies with high earnings growth potential. To identify these stocks, investors analyze the company's financial statements, industry trends, and other metrics. They look for companies with a competitive advantage, strong management, and a history of innovation. Growth investors believe that these companies will continue to grow, and the stock price will rise accordingly. Dividend investing. Dividend investing is a strategy where investors look for stocks that pay dividends. Dividends are a portion of the company's profits that are distributed to shareholders. Dividend investors look for companies with a history of stable dividend payments and a high dividend yield. They believe that these companies are financially stable and have a long-term outlook. Dividend investors also look for companies with a history of increasing their dividend payments over time. Each investment strategy has its pros and cons, and investors should choose a strategy that aligns with their investment goals and risk tolerance. Value investing is generally considered a lower-risk strategy, as it focuses on companies with strong fundamentals. Growth investing is considered a higher-risk strategy, as it focuses on companies with high growth potential. Dividend investing is considered a lower-risk strategy, as it focuses on companies with stable dividend payments. However, each strategy can be profitable if implemented correctly. Understanding market trends and how they affect stock prices. Understanding market trends is an important aspect of investing in stocks. Market trends refer to the overall direction of the stock market, which can be influenced by various economic, political, and social factors. These trends can affect stock prices, and investors need to be aware of them to make informed investment decisions. For example, when the economy is growing and companies are performing well, the stock market tends to rise. This is because investors are optimistic about the future prospects of the companies and the economy as a whole. On the other hand, when the economy is in recession or there is political uncertainty, the stock market may decline as investors become more cautious. Tips for successful stock investing. Successful stock investing requires a combination of different skills, knowledge, and strategies. Here are some tips for successful stock investing. Diversification. Diversification means investing in a variety of different stocks across different sectors and industries. This helps to spread out the risks and minimize potential losses. By diversifying your portfolio, you can reduce the impact of any single stock or sector on your overall portfolio performance. Long-term investing. Successful stock investing requires a long-term perspective. This means focusing on the long-term potential of a company rather than short-term fluctuations in stock prices. Long-term investors can benefit from compound interest and the power of time to ride out short-term market volatility. Patience. Patience is a key virtue for successful stock investing. It takes time to build a profitable portfolio, and it requires patience to wait for the right opportunities. Investors should avoid making impulsive decisions based on short-term market trends or news. Research. Research is essential for successful stock investing. Investors should do their due diligence and research companies, sectors, and industries before investing. This includes analyzing financial statements, industry trends, and the competitive landscape. Risk management. Risk management is an important aspect of successful stock investing. Investors should have a clear understanding of their risk tolerance and should adjust their investment strategies accordingly. This includes setting stop-loss orders, diversifying their portfolio, and avoiding high-risk investments. Consistency. Consistency is key for successful stock investing. Investors should have a consistent investment plan and stick to it, even during market downturns. This means regularly contributing to their portfolio and avoiding emotional decisions based on market fluctuations. In conclusion, investing in stocks can be a great way to grow your wealth over time. While there are risks involved, with proper research and due diligence, investors can make informed decisions and potentially earn significant returns on their investments. Remember, investing in stocks is a long-term commitment, and it's important to have patience and discipline. It's also crucial to diversify your portfolio and not put all your eggs in one basket. Don't let fear hold you back from investing in stocks. With the right mindset and approach, you can potentially earn significant returns and achieve your financial goals. So, take the first step and start learning about investing in stocks today. Thank you for listening to this video. I hope you found it informative and useful. If you have any questions or comments, please feel free to leave them in the comments section below. Don't forget to like and subscribe for more content like this. Thank you again, and until next time, happy investing!